Good morning, everyone. This is Daily Trading Analysis with the market forecast for today, 4th of November. After yesterday's sideways range day, we closed the day in the lows. So during overnight and pre-market, we've been slowly grinding higher, but rejecting 10,800 on the Nasdaq. So be careful because pre-market high remains strong, and we have a lot of volume. As you can see, this is a bell curve as equilibrium volume profile that sits at 10,800. So still this level is super strong and remains as resistance for the day. Today it's Friday. We've been seeing and reviewing a lot of economic data, and we are quite exhausted of that, but today is again a very important day, the last day of the week. So let's check the economic data for today. Non-farm payrolls and unemployment, big ones today. Payrolls, we expect lower payrolls, 200,000, a huge decrease. The consensus is 63,000. I think that will be quite positive for sure, but I don't know if that would be the case. If payrolls came as expected, this will boost the market for sure. And also unemployment, we expect to remain flat or even a little bit higher. I don't know about that. Labor market remains strong, but we need to focus on payrolls. We need people to stop getting money, basically. And if possible, start losing their jobs. This is hard to say, but we need that. Fed is watching those two. Those will be released 1 hour before market open, 8:30. And I would like also to highlight the earnings right now are quite bad. We usually average 70% on a bullish market, but right now it's 63% is weaker than expected. I mean, obviously the forecast is bad. The guidance have been bad for all the big tech guys, and all people is basically closing the year in the weak side, and earnings is just showing this weakness across the stock market. This is expected, and this is something that I think is good to happen. We need all the stocks to start going down and to consolidate between going higher with big economic data supporting a bullish sentiment. Also, apart from that, I would like to highlight also something that I usually review on the channel, XLY consumer discretionary versus XLP staples. As you can see, this is since the start of the year, discretionary has been going lower and lower and lower and lower. So staples have been going higher and higher and higher. So the spending on staples is something that does not help the economy. We need discretionary to people, the consumers, to start spending again. This is good for the Feds. Don't get me wrong. We are seeing a good low spending on consumer discretionary and a lot of money going to staples. But at some point, we need to inverse to revert this trend and start spending on the consumer discretionary side for the markets to go up. But for now, as you can see, it's quite clear, XLY is super weak, and we can check that on the charts. We have XLY getting destroyed basically. As you can see, this is since the start of the year is going lower and lower, making lower highs, and we are approaching the lower low, something that is super critical. If we break that, we are at pandemic levels, more or less. But if we break this line, the next stop would be basically the low of the pandemic, when a lot of spending, consumers were not spending anything on anything. So be careful, because this is one of the keys for the recession call that a lot of people is calling out. And if we make new lows, forget about markets double bottoming or finding any bottom in the near term, so for the end of the year. I talk about consumer discretionary following the ratio that I'm showing right now. This ratio is XLY consumer discretionary versus XLP. So as you can see here, XLY is being weakened, XLP is stronger, and this ratio is the weight, the equilibrium that we need to follow. When XLY curls from the bottom, then we can see a slightly reversal on the trend on the spending. And this is something that you need to watch if you want to find any bottom on the consumer side that will impact the overall market. So what else? Dollar, as always, dollar is, well, it's coming from the bottom of this 109 and it's relatively strong, but don't forget about these tops, double top that we have on this resistance level. We are right now trending up, super up. As you can see, we are going farther than the channel. So this double bottom at 114, you need to watch this, because I think supply resistance will come again at this level and perhaps we can see a pullback. Right now it's in the middle on these two levels, 112 and 114. So more or less in the overnight, we are seeing a little bit of weakness ahead on Friday. It all depends on the economic data that will be released 1 hour before market opens. Watch the dollar and also watch the yields. Yields are a crucial part of our situation and it's a leading indicator. A big spike, this spike that you can see, this is from FOMC, this spiked to 5.13. This is the 2-year yield that spiked a lot crazy during the FOMC press conference. Right now, still trending up. As you can see, it's far above its average for the moving average, and we are approaching June 2007, and I already put this 2006 level at 528 for the 2-year. This is crazy levels. So be careful, because I have 2 alerts. One for the break of 5, that is key for the 2-year, and also another one for the breakdown to 4.5%. The 2-year is crazy high. Right now is in the green for the day. But we also have to review the 10-year. The 10-year is also trending higher. If you check the daily, we went above June 2008 and we are approaching 2010. Sorry, this is incorrect. Let me check that. This is 2008. So this is gone. This is 2008. So we are approaching these super levels seen from the Great Financial Crisis, GFC 2008. This level was already crossed and we are pulling back, but again, we are bouncing and approaching. We left behind the 4% that I have an alert around here in this consolidation, but after FOMC, both 10-year and 2-year went crazy high. So what are bonds market pricing in? If we check December this year, we can see that they are pricing in 4.17. So we went 4.24 and we are consolidating up here. So obviously with the Fed hiking 75 basis points on Wednesday, these rates are adjusting, these yields are going higher. The forecast for December is maybe, I think, is 50 basis points. And this is not the worst. The worst is for next year. Since the 4.17, you can see here, this is April 2023. It's leaving behind 5, establishing 5 as a key support, and we are going higher since April to September 2023, 5.15. So it's not only that we are going to continue hiking aggressively until April. bonds market are pricing in that since April until September 2023, we are going to hike at least one more time, maybe 25 basis points. So people have no idea what is coming. The worst is yet to come, and we will be reaching crazy levels, and we will be at those levels a lot longer. That's what Jerome Powell said on Wednesday. And maybe 6 to 9 months, because this is December. December is pricing in 4.9, so maybe since September until December, we might be seeing one or two cuts of 25 or one big cut of 50. But remember, be prepared. Interest rates are going to reach crazy levels. People have no idea what is coming, and we traders and investors that are trading the market have the edge, have the information, and we have a crazy advantage to be prepared for our economies, our personal economies, but also take opportunities from the market. So remember, watch the dollar, watch the yields. Those are leading indicators, are key indicators in this situation if you want to take opportunities and to have an edge on the market. Let's talk about stocks. Apple with 2.21 trillion market cap, it's basically flashing and dragging the market down. This is quite easy to understand, and it's also leaving these gaps behind. So be prepared unless Apple bottoms at this 137 in this early October pivot on the daily. We are not seeing any bounce if Apple continues this trend. Not only Apple, Microsoft. I uploaded a quick video, a short video sharing this. Look at this huge trend line that is uptrending since 2018. It was well respected, and now Microsoft is surprisingly on the weaker side. I expected more from Microsoft, but it's clearly having a lot of stress, a lot of pressure to the downside, and we are seeing a lot of weakness. We are breaking down this trend line and approaching December 2020 levels. Those levels are a little bit higher than the pandemic ones, but I think everyone is watching these levels. These pre-pandemic levels are key. I will manage your expectations. I think we can see pre-pandemic levels on a lot of stocks coming up. Tesla, it's holding surprisingly well. It's holding the 206 and also 200 pivot. It's really quite choppy, but if you check the 30-minute, it's holding. It's not obviously it's going down, but it's holding quite well. I think people like Tesla not only for the volatility, but also for the obvious strength of the market that is trading on. So Tesla is the refuge of a lot of traders instead of Apple and Microsoft that we are seeing a lot of weakness in there. Amazon, consumer discretionary, look at this. Amazon and Google are also breaking down and leaving these huge gaps behind. Amazon approaching 2020 levels. If we check the weekly, it's insanely weak. Insanely weak. Well, it is what it is. Manage your expectations. Trade the market you are in. Don't think that one or two green candles are bullish market, because the trend is quite clear. You can see the levels that we are leaving behind, strong levels. And for today, I expect some kind of a bounce, but it is key to wait and to have patience until non-farm payrolls and unemployment data is out, and then plan your trades and manage your positions accordingly to those news. I won't be trading before. And I will be waiting a lot to maybe this kind of pivot. In here, we have a very clear pivot here and also the 10,800 from yesterday. So these two pivots are quite important. Right now, we are not breaking the pre-market highs, and unless we break that, I don't think I'm taking any position. S&Ps, you can see, way stronger than the Nasdaq. We've been mentioning that for a lot of days and weeks. We are approaching this 3,750, and the next stop is maybe try for the 3,800. But this previous support is now resistance, and I don't think we are breaking that easily. The Nasdaq also has very range day and has a lot of weakness because all the big tech guys are reporting bad earnings, bad guidance, and we are seeing weakness across the board. So as always, be patient. We need that economic data to form a bias and to trade, I think, with good risk management for opportunities. Don't forecast, don't expect, just react for those news and manage your position accordingly. Thank you for your time. If you have any questions, do not hesitate to throw your questions and comments down below. If you found this video useful, please remember to click the like button and subscribe to receive notifications when I upload new videos. Remember, I upload new videos every single day for market forecast, market updates, and market recap. I appreciate your time and see you in a couple of hours with the market update. Remember, discipline and risk management are key for success. Stay safe, everyone.